So now we are seeing the rates reverse.
Yes.
Again, pointing that you've not used the rates to market yourself, but somehow that has been attractive enough for clients. What happens after the rates go down? Do you see a different ball game to approach of how to keep growing the assets under management, how to keep growing the business for fund managers?
Anyone who's coming on board and applies to get a license as a fund manager, they have their own strategy. So for example, if you deal with money market funds alone, the reason why people put money in money market funds is just to create a savings culture.
Hi, and welcome to another episode of Make Money the podcast. My name is Kepha Muiruri, and today we have another conversation on unit trust or collective investment scheme. Some of you might call them money market funds. And we've continued to see these asset class grow in leaps and bounds, nearly touching 400 billion shillings in assets under management as of the end of last year. And what we are seeing now is that fund managers are facing cyclical changes here, and this being interest rates. So we've seen the interest rates on these asset class come down, but even with that, we are still seeing flows continue to this asset class. And for some fund managers, we've seen a lot of them, perhaps leverage the very high interest rates on offer to market to clients. But now what happens when the rates begin going down? And the question I'm asking today to my guest is the unit trust party over? And I'm happy to have Mr. Kenneth Maina, managing partner at Etica Capital. You're among the new kids on the block. You've been doing a lot of work, in terms of the growth in assets under management and the return we've also been offering to clients. So welcome to the podcast, and it's great to have you finally after a lot of conversations on call and on text.
It will look like you've been chasing me for long. Yeah, but thanks a lot for having me here.
Yeah.
Really honored to be here to discuss how the space looks like, especially because rates are also trending downwards. What's there, what's available for clients, and how people can adapt. I think when you say Etica is a new fund manager, in the office we are saying we are no longer new. We got a license in 2022. So I think by year 3, the baby is eating solid food now.
He's eating solid food.
He's eating solid food,
Wind of milk.
So thanks a lot for having me, and glad to have the conversation.
Great. And I'll take it off right from the context I was setting here. We've seen fund managers almost, leverage without even making noise about it. I think something we mentioned on the side, it's not like fund managers have been making noise of the returns they're able to generate for their clients, but that return has helped drive interest in this asset class. When someone can get between 15 and 20% and almost match up to maybe asset classes they wouldn't access, the treasury bonds, fixed deposit accounts, they've been able to match using unit trust the same return as someone who would be directly purchasing some of these instruments that command quite a higher entry level. So now we are seeing the rates reverse. Again, pointing that you've not used the rates to market yourself, but somehow that has been attractive enough for clients. What happens after the rates go down? Do you see a different ball game to approach of how to keep growing the assets under management, how to keep growing the business for fund managers?
Okay, I think that's a good point to start. Maybe I'll just maybe have a slightly different opinion from yours. So in terms of the numbers that clients that fund managers are reporting, yes, CMA reported we're almost close to 400 billion in terms of assets that people are managing. Most of the fund managers are also growing on a daily basis. So yes, number one, you fairly attributed it to interest rates. Yes, if you look at it, last year rates were peaking almost. You could see fund managers reporting between 16 to 18% per annum. The same has come down now. If you look at the people who analyze these things on the side, we are doing from 16 now all the way to single-digit returns. As much as that is one of the reasons why the market has grown, I would also tend to include other elements in why the market has also grown. So if you look at it, investor education is number one. The role of investor education, if you wake up every day, you open your newspaper, you open social media, there's a conversation which is ongoing about savings and also money market funds, which is good. It's also good that when you mention unit trusts, people also think it's money market funds alone. There's a whole basket of other products that you can get from there. So number one, it's about the conversation that is also driving people to start saving. And then we have a very enlightened generation who are keen to enhance their savings culture. They may not be doing long-term saving majorly. No. They may even be doing short-term saving. So you'll see someone saving for holiday, someone saving for something in December, someone saving for school fees, someone saving for something, which is a good point to start from. So if you put that, so the high interest rates and also the culture itself is also helping. You also put the role of the regulator. Mm-hmm. Our regulator is Capital Markets Authority, CMA Kenya.
Yeah.
They've also done a very good job. If you look at the players in the industry, maybe I think even if you say the last 1 week, we saw them do a press release and there's a new fund, a player in the industry, a new fund manager. If you look at the last, let's say 1 year, 2 years, 3 years, we may have 10, 15 new fund managers. So yes, the role of the regulator has also helped very well. Because see, anyone who's coming on board and applies to get a license as a fund manager, they have their own strategy. Yeah. I would, let's say, divert a bit and say, so for example, look at Etica Capital. When the strategy was being formulated, the company chose to target the bottom of the pyramid, which was being served. Mm-hmm. So anyone coming on board is trying to come up with their own strategy, and that is also helping the numbers grow. Because if I see a gap in the industry, I'll be like, step in to fill it. I'll apply for a license. They'll do the due diligence on the shareholders, on the employees and everything, and then they give you a license. So yes, it's not just interest rates, but also other factors. Now, coming to your question, it's more about how is the fund manager adapting to the same. Yeah. If you look at it from the perspective of fund manager, number one, we will get questions on a daily basis. How comes rates are coming down? Especially a client will put money and they tell you, I'm adding more money, but my return is coming down. But we don't live in isolation because technically we get the returns from the market. Yeah. So what the fund managers are doing, so number one is you enhance the education to the client, make sure they understand the different cycles of interest rates. Mm-hmm. Historically, even if you look at it on average, returns for money market funds, they are between 10, 11%. So even the spikes to 16, 17, 18 were one-offs. Yeah. So now, first thing is investor education. The second thing is now you try to come up with more products. Because see now, if you look at the CMA, if you look at the CIS guidelines, which were released in November 2023, there are different types of funds that you can try and come up as a fund manager. So it's what you call traditional funds. There are 4, and then there's special funds. Yeah. So traditional funds is a money market fund, a fixed income fund, a ballast fund, and an equity fund. Yeah. So traditional. So money market fund, I think that's the most common. Fixed income fund just deals with fixed income securities. Equities fund mainly invests in stock market. Mm-hmm. And then you have a balanced fund, which can have either of both. Yeah. So what most fund managers will do is now try to convince the client, if you have a bit of more risk appetite, because the products have different risk appetites, they can switch over to where now the return is a bit better. Yeah. So if you look at it, when the rates were very good, it was making sense why people would choose a money market fund other than other different products. Yeah. So as a fund manager, you're just working very hard to make sure that you are continually innovating and getting better products in the market. Yeah.
And I like you spoke that it's not just about the interest rates.
Yes.
And before we even come to the point, I think here we'll have to appreciate what audiences do. You know, they decided to call this thing MMFs, and it's okay. We still have to do a great job in presenting them as collective investment schemes, yes. Trust, and then breaking down the understanding, like you did say, it's 4 main funds.
Yes.
But now coming back to the conversation here, like you say, it's not just about interest rates. And what we saw between October and December is fund managers have continued to grow their assets under management. New entrants are continuing despite what has been softer interest rates, interest rates coming lower. Does this speak to the other factors you did speak about here, that, it's not just about the return. It's not that we are just coming to the market with the return, and if that goes away, that means basically there's no more growth.
It actually does. It actually does, because if you start with number one, investor education, number one, so you are trying to make sure that when the client is coming on board, you give them the reason why they're investing. So for example, if you deal with money market funds alone, the reason why people put money in money market funds is just to create a savings culture. So the alternative to putting money in a money market fund would, let's say with your savings, you take it in a bank. But in a bank, you're earning zero if you're earning very little or zero. Yeah. So if the money is in a bank, you are losing actually because of inflation. Mm-hmm. So technically now, most of the returns that you're generating as a fund manager on this side is to help the client shield against inflation. So what we are seeing, most of the people who are coming on board, the rates may have come down, but for them per se, I'm still much better since I'm getting a return which is still beating inflation. And that's where we should be driving the conversation to, because if you look at it, rather than money staying idle where you are losing, it rather be earning, even if it's the minimum return. So long as
you're just beating inflation.
Yeah, I know. I know we may get to that one because we spoke about it on the side.
Yeah.
Because when someone says, "I want to make sure the client beats inflation," someone will call you a lazy fund manager. But that's a conversation that's a conversation that we'll still have today.
Yeah. So in terms of the flows that we've continually seen, and it's, you said the context of some of it, it's not just about the interest rates, it's also other things you're addressing. There's a lot of hypothetical thinkers out there, because these are not situations that have material, so I'll just call them hypothetical guys speaking, saying maybe it's time some of this money find itself in other asset classes. I think I look at some of the markets like the US, they have nearly 2 trillion shillings in their equivalent unit trust. And the same we are seeing here is, despite the rates coming lower, people have not dashed out to see what else they're finding out. And do you expect these flows then to be quite sticky? I believe they would be sticky, because I believe most people don't even know where else to take their money. It could be other asset classes, but either the risk profile of them, the investor knowledge allowing them. Some people just, do understand how unit trusts work, and they've seen how it's worked for the last few years, and they rather be comfortable there with, if inflation is out 0.5% and you make even 7%, you're still beating inflation.
You're beating inflation.
Yeah. So do you feel then, because of the familiarity of investors, especially retail investors, with unit trusts, with money market funds, then we are likely to see these flows remaining there? Because the hypotheticals have been talking about some of this money finding itself into equities. I'm yet to see that.
It's I think the best way to tackle that one
is
we need to understand who the average or typical investor is.
Yeah.
So from the data that was released by CMA for December 2024, you look at it and you'll see around 63% of the clients are in money market funds. So that one tells you, number one, the people who we have are very, the risk appetite is very low. Also, number two, it just tells you that most people they would rather a place where they are guaranteed capital preservation. So with that one, now if you now couple those two, so you'll see why money is still there. So now the next thing is, why is the money not moving from CISs to other
asset classes and whatnot?
Yes. So now, since we've actually seen that the average investor doesn't want risk, if you look at the risk for the particular funds, is a bit different. So let's say an equity fund, the risk is high, because if you put, let's say, 1,000 shillings today, it will be 1,000 tomorrow. It will be 2,000 tomorrow, or lower than that.
Yeah, could be 500 shillings.
It will be 500 shillings.
Yeah,
and that's how the cyclical nature of the market is. Now, the average investor doesn't want to make a loss.
True. In
this particular regulated, I think we are peculiar people, as Bob Collymore said. This is Bob Collymore or Michael Joseph said.
Yeah.
I don't want to make a loss in a unit trust fund, but even if I make a loss in my business outside there, I'm okay.
Yeah.
So that's how we are as a country. So that's why you'll see the money may be a bit sticky towards the money market funds, though we still need a lot of investor education about different products.
Yeah.
Because as we started this conversation, we were saying most people think unit trust funds are just money market funds.
Yeah. Sadly.
Yeah. And rightly so, they're contributing to 63% of the entire funds.
Schemes,
If you look at it, the beauty of it is, I think if you take 63%, around 17% is in fixed income funds, which depends on a fund manager.
Yeah.
Then 18% is in special funds. So there's opportunity everywhere. I would be more happy if people were to put more money in, let's say, in equity funds.
Yeah.
So that we can grow our stock market. But I think that's a conversation that is for a different day. Because if the market is a bit dead, it makes the case a bit difficult for you. So if you were to ask me whether the money would be a bit sticky, I would say the money would be sticky. Money would be sticky so long as you're still making a return which is above, let's say, inflation. The clients will still put their money there since they're not losing.
And I think this segues very well with the next question I had around the important factor played by the need for capital preservation.
Yes.
So basically, capital preservation, just to put it simply, is I don't want to lose my money.
I don't
want a loss.
Money.
So even if I brought 1,000 shillings and at the end of the year you just tell me I have 1,100 shillings, it's still better than nothing.
Yes.
And you did mention rightfully, market swing equities will be more volatile than unit money market funds, for instance,
exactly.
or like fixed income fund where the return here is predetermined. Do you also feel now this also helps galvanize where a lot of these monies might not even leave the space? Actually, we might report on 400 plus billion for the first time in the next quarter. By the time we finish this quarter, we're in March already.
Actually, the quarter we are in, I can bet will be past 400.
Yeah.
Based on the numbers that I've had, people are growing with.
Yeah.
Mainly because if you look at the number of people, I think if you look at the report, about only 1.4 million people have accounts in the unit trust space.
Yeah.
1.4 million people doing around 389 billion, meaning that and actually even if you were to just look at how many people are employed, or file taxes, it's between 4 and 6 million.
True. There's still some way to go.
So it's still some way to go.
Yeah.
So even if you were to say every employed person to have an account, there's still some way to go.
Yeah, still have around 3 million, maybe 3 million, maybe they just double from where they are. But
yeah. Then number two, if you look at even the people who are not employed formally, but they still can afford to do savings, there's still quite a significant chunk. Even if you go now to the students, because there's another culture we are seeing, I would give you a fact which will shock you. Around 50% of the clients at Etica are below 25 years old.
Interesting. So these are just new graduates.
Yes.
At best.
That year and below.
Yeah.
That year and below is around 65%.
Yeah.
The clients. So you see, there are people who are willing to learn and also start the savings culture very young, which is very commendable.
Yeah.
So we still have a long way to go. There's another metrics that people use. Is not like for like, just to show you that we still have a long way to go and will not, the numbers will still continue growing. If you look at how much is saved in the pension industry, that's someone saving for their pension, it's quite a lot. It's over 2 trillion. Where our space for unit trust space is below 400.
Yeah.
So even if we were to do only half of what the pension business is controlling, just by inculcating a better culture of savings,
runway for 100 plus.
There's still a runway for
to add.
Not even 100, more than 400.
Yeah.
So if you ask me, is there still space for the same to grow? There's still so much space in terms of the number of clients, and the number of clients also. There's the recent player who was brought on board by the mobile provider.
Yeah.
So that also may spur the number of clients who are coming on board from the 1.4. The reason I'm saying that is because if the primary tool is via M-Pesa, and M-Pesa has 40 million clients.
Yeah.
So the next report, you may just see a jump from 1.4 to past 3 million.
Past 3 million, true.
Of the people who are active. But that, we're waiting for it to happen. So if there's a slowdown, I don't think, there's no slowdown.
Yeah.
Yeah, we'll still continue growing.
Sure thing, yeah. And now here's where I'll bring out the criticism I've been picking on social media, on WhatsApp groups, on even family conversations. People feeling, someone describe the growth we've seen around the fund manager space as quite, someone compared it to the quail business. I think it was a bit harsh. I don't think we are selling any quail eggs with fund managers. But anyway, taking that point, and then, for others, they just feel, this is a treasury bill with a fund manager's fee in place. What do you make of all these views? It's almost, admirers and haters in equal measure almost. Because of the work you're doing, I'll still say, even if you just deliver a high single-digit return, you still the contribution of the collective investment scheme to savings in the country has done quite well, and it's quite admirable, even if we don't have to discuss returns.
Yes.
But I don't know what you make of the views. Some people just describe, it's just
lazy fund managers.
Lazy fund managers. I have a colleague, an industry colleague from one of our peer finance media house, talking about lazy returns.
Yeah.
I don't know what you take of these criticisms sometimes. Is it harsh? Is it fair? Feeling that fund managers have it easy and they've somehow found the magic wand to just keep growing that AUM while just sitting around.
No, I think you've raised 3 points, which we can just have a discussion around that.
Yeah.
The first one is, I've also heard that comment about the quail business, or the pig farming business that is happening.
Yeah.
If you were to ask me, I think number one, we need a bit more of investor education in the country. The main reason I say that is because if people understood why something is happening, they'll be in a better informed position to critique it. So I would start from, let's say, if you put it for the last 2-3 years, we may have 15 new fund managers, including Etica Capital. So 15 new fund managers, definitely people will have noise and say it was all quiet, and then all of a sudden there are 15 new people who are still being licensed. So what's happening? It's, put it rightly, it's the same way you can say, let's say the stock market has been dead for so many years. I think the last decade. More than the decade. If let's say this year or next year we start having 4, 5, 6 IPOs the year, then people will be skeptical. They're like, now this one is too much.
It's become the new quail again.
So that's the first thing. So there are very new players in the industry, so you'd understand why someone would have an issue with that. Then the reason why I said we need to more finance education and the like, financial literacy, is also people need to understand the structure of a fund management industry. If I was to give you an example with Etica Capital, we applied for a license in July. I think the company was incorporated in July 2021, but we got a license in August 2022. So a whole 1 year. And the whole 1 year was because the regulator with CMA had to do background checks on everybody just to confirm these people were giving a license.
They're who they say they are.
They're who they say they are. Then if you get a license, you usually get 2 licenses. So it's what we call a product license and a fund manager license. So the fund manager business sits separately from the products. So even when you see reporting will start happening in this month of March, because we're also supposed to report our numbers as at the end of the audited numbers at the end of the previous year. So we're supposed to present to publish the same in newspapers before the end of March. So you'll see all the fund managers, the template is the same. You have to publish as a fund and also publish the results for the company. So now the part where people will say this is a quail business is they'll see the company is making losses. Then they'll say these guys are making losses, but they're giving a return of 16%.
And you're giving them
How is that possible? Well, it is not like for like. Mainly because the company has set up costs. And actually how a company generates revenue for it to run its business is based on the assets it's managing. So when you're starting, you don't have assets to manage. So you don't even have management fees. So even if you come and report, let's say you report 200 million. I'll use 200 million because it's an example that we used as Etica. You'd make, so 200 million, you'd make revenues of 2%, maybe that's around 54 million. But 54 million is not enough to run the business. So you see what will happen is now people will start critiquing, saying, why are you guys making a loss? But now ideally, it's the shareholders who own the particular entity who are digging into their pockets more and more. But if you now go to the next set of financials, you'll see there, this fund, the profits, this fund, the profits. So at the client level, they're not affected. Because the fund manager will build the fund, they get the management fees, then they go to run their business. So the when people talk about the quail business, it's more because they're saying, oh, these guys will report losses. But honestly speaking, you don't expect someone to be new this year and make a profit, steady to profits. Actually, year 1, year 2. I think most businesses from year 3, 4, 5 is when they start stabilizing. And also anybody who is 20 years old, they started one day by being 1 year old.
True. They didn't walk. They
didn't walk. They started crawling and they got there. So you'll see most of the guys, so long as you see the trend is reversing, I think that's fair. The other thing that you had highlighted was in terms of lazy fund managers. I think their fund managers are bashed a bit unfairly. I think they're bashed unfairly. There's a lot of work they do in the background that people would say it's lazy, but it's not lazy fund management. The noise you get in the market is mostly because if you see if you say 63% of the funds are in money market funds, so most of the noise will be around money market funds. 63% of the time is proportionate. there's so much that goes into on the back end, structuring the fund, setting up the business, so that you're able to charge that fee.
Yeah.
Because I think when people say it's lazy fund management, it's because they're saying, you guys will just take money, you take it to a T-bill, then you give me, then you take your 2%.
Take your 2% from it.
No, there's a whole team on the back end doing research and doing, so actually the 2% is just to, also to generate the returns for the product. And if you look at it, most fund managers are very innovative. They're getting innovative, just trying to see how to make it better, and you see more products there. It's just that some products they don't gain traction as other funds. You may have a money market fund, but you ask a fund manager, they tell you that's 90% of my clients. My client will walk in here, I explain to them my market fund is a low risk fund. They're like, that's okay. Then you tell them I have an equity fund, it's a high risk fund. They're like, I don't want. So that one is I don't think it's just because number two, the other thing the fund manager gives you, now if you compare the two asset classes, because someone is saying they just take money to T-bills and they take it back, is the liquidity. People forget that when the rates are going up, if you try to sell that asset, you'll make a loss.
True.
When the rates are going up, But if you put your money with the fund manager, and no matter the cycles, and you put in a redemption request today, he'll pay you. He'll pay you the same. So they're also charging you for that liquidity that they're giving to you. I think what I usually say in conclusion is every player in the industry has their own role to play. By that I mean there's a role that fund managers play that banks cannot play. There's a role that SACCOs play that banks and fund managers cannot play. So each person is we coexist peacefully because there's something I do that this particular person cannot give. So in terms of giving products and returns and taking the same and charging a fee, I think it's an unfair criticism. Maybe the last point that we had also raised was about the returns. Because I think the Quill business was known for returns. The initial guys who came in, they had very high returns.
It looks like a pyramid scheme.
It looks like a pyramid scheme.
The initial guys made all the money and it didn't trickle down all the way.
The way. A spot check on the returns. If you look at the returns for the last, because there are people who independently analyze the returns for different funds. Because you just get the newspaper. See, they're published there. You just rank them. There's nothing much. There's nothing wrong you're doing. If actually when you look at now and you look at even the guys who are giving high returns, they are new fund managers, and it's a very simple reason. They don't have legacy problems. They came in when the returns were very high. But now the rates are coming down. There was a very interesting quote I saw maybe 2 weeks ago in some conference I saw. Someone said, if the return of your money market fund is not coming down, then it's not a money market fund.
Something else.
It's something else. So if you look at it, they peaked, let's say, at around 18%, but also they're coming down. Mainly because they're trying to mirror what's happening in the industry, in the market. It also depends on how big your fund is. Because your fund is big and you try to reprice it, either downwards or upwards, it may take time. So the challenge last year we had, and that's why people could say these guys are cool people, is because a legacy fund manager, you've accumulated a stockpile of, let's say, 30-40 billion of assets you bought at 10-12%. On this flip side, and they're not maturing, because the problem is they're not maturing. On this other side, this other guy is new, he's getting new money. When he goes to the market, T-bill is going up. Bank deposits are going to 18%. So that was just the main difference. But I think also, if you look at it, the structure is also good. CMA is doing quite an impressive job so far. Fund managers have to report to CMA on a quarterly basis, on a monthly basis. So it's not a Quill business as people are putting it. It's not fair.
All right. Great. I think the last one I had is just around, like we said, traditionally it's been money market funds, income funds, equity funds, and a bit of balance fund. But now we are seeing the entry of also special funds. I know the sophistication goes up. The risk profile changes for these funds, but we are still seeing some growth there. And I wonder what do you say maybe the driver? We are now even seeing people come into you. I know you have a USD fund already. Some might fancy that over your Kenya shilling fund and not worry much about the interest. They just want to have some foreign exposure. What do you say perhaps is changing this tone so that perhaps 3-4 years from now we will actually get the differentiation right? I don't want to have to explain unit trust and collective investment schemes are just you know,
the four traditional ones. The four traditional
ones.
Because
a lot of times we just say MMF and someone assumes you all know what you mean.
You all know what you mean.
Yeah,
true.
Yeah. So what might be what's this driving this interest in also, you know, some foreign exposure, you know, the same type of funds, but now we are seeing fund managers like yourselves, you know, applying for these new funds that are special or differentiated from the norm. What might you say is the driver for that?
So we are dealing with a very informed and tech-savvy generation. That's the first thing. So any fund manager who is able to give them an exposure in, let's say, Google and the likes, and those things, they'll be very quick to jump into that one. And you see, the good thing with a CIS, a collective investment scheme, is it allows you to be included with other people, so they can be able to afford that one. Mm-hmm. Even if you just say, if you don't go to the special funds, just put it locally, just divert a bit. If I was to go buy a T-bill, I need 100,000. Yeah. If I was to go to buy a bond, if it's a FXD, it's 50,000. Yeah. So most people don't have that 50,000, right? Or 100,000. Mm-hmm. But they have 1,000 shillings and they want exposure in that one. Yeah. So that's what most of the CISs will do. So if you have, let's say, a fixed income fund, people will buy that one, and the ultimate investment of that fund, it's buying into a government bond. Yeah. Now, if you look at these special funds, we are dealing with people who they want an exposure in particular stocks, and also the risk appetite is a bit high. Yeah. Because also the risk factor, if you look at special funds, the risk factor and appetite is a bit high, and how the fund is structured. We have so if you combine the two, if you combine the risk aspect and also combine how people are more informed, that's why you're seeing now people demanding for these things. For example, I'll give you an example. When we were starting Etica Capital, we didn't have a dollar fund. Yeah. So we started with 4 traditional funds, shilling funds. Yeah. Most of the calls that we got from clients were, why don't you guys have a dollar fund? Mm-hmm. We need a dollar fund. We want a dollar fund and the likes. So that it means now the clients are demanding for a particular thing. So if you look at it, a client maybe say, how comes if I'm sitting here, how comes I can't buy a small exposure in a stock in the US? Yeah. And so now a fund manager will be like, okay, that's what people want. Okay, if that's what people want, I just structure a fund that now collectively will be investing in those special funds. Yeah. If you look at it, for them, they require a bit more sophisticated investors. If you look at as per the regulations, you need a bit minimum of 100,000 Kenya shillings. That's why they say now at 100,000 Kenya shillings, you're willing to invest that one. You are a person who is more knowledgeable and you understand how the market would be in that particular aspect. It's a very warm welcome to that one. I saw in the report around 18% is special funds. Yeah. So special funds would include even the likes of Sharia funds, the likes of I think we have Mansa is over there.
Mansa, we have the Oak Fund from
the Oak Fund over there. Yeah. So it just shows that there's an appetite people, because you see, before those guys come up, before a fund manager comes up with a product,
must be in response.
They've done a research.
Done their market research. They
because I don't think it's
one day and decide.
There's this product you can come up with and go to the market with is a money market fund, because there's already market 63% already is there.
Is already there.
But for you to come up with a special fund, it's because you've seen a particular need that people want, and that's why you are coming up with the same. Yeah.
Yeah. Right. So, Mr. Ken,
yeah,
thanks a lot for being part of this conversation, and I hope anyone listening will get to learn a bit more, understand it's not a quail business, it's not lazy returns, there's a return to fetch from the market, and there are all these market swings.
Yes.
And there are all these other drivers for that. So we appreciate your time on the podcast, and
thanks a lot for having me.
Happy to have you some other more time. I don't know what else comes within the next year within the space, but we are watching the AUMs, we are watching the rate of return, and we're also watching the number of people invested in there.
Yeah, we'll keep a track. Thanks a lot for having me. I think we'll keep a track on how the market is evolving in terms of assets under management in the market. We hope that 63% in money market funds may adjust slightly, so that other funds also can. Because you see, if you have people putting money, let's say in equity funds, it will also spur the stock market.
Great.
Stock market would actually perform even better. So we hope we see more interest in this particular sector, people putting in more money, and from Etica Capital, we're very happy to have discussions going
Good.
forward. Yes.
All right. That has been Kenneth Maina, managing partner at Etica Capital, and he's walked us through the twists and turns inside the unit trust asset class, and I do hope you've gotten to learn quite a lot from the conversation. That has been another episode of Make Money the podcast, and my name is Kepha Muiruri. See you next time.